Well, hello again, everyone. Welcome back to the channel. Let's hope our technical issues are all resolved by now. I think they are. So, as promised, I'm going to do a live reaction to Blake Downer's video, How to Pick Stocks, Part 1. So, let's dive right into it. So, I'm going to go point by point and react to what he has to say. Overall, it's a pretty good video. So, let's go ahead and get started.
Hello, hello. I get a lot of questions on how to choose.
Oh, I have it on 2x. Let me slow it down here, or I have it on 1.5. Let me slow it to normal speed. Here we go. Okay, so first off, for starters, he's got his average return and success rate on Seeking Alpha here, which is pretty good. 15.6% average return per rating, 35 out of 49 ratings made a profit. Pretty good stats.
Choose individual stocks. If I had to boil it down to a simple process, I'd say that I follow these three rules. You must achieve situational awareness. You must choose competitive companies with long term compounding potential. You must only buy things that are trading well below their intrinsic value so that they have a margin of safety.
So I agree with all three of these rules. To the third one, I would say this sounds very similar to what Warren Buffett talks about, um, but it's harder and harder in this day and age to find stocks that are really below their intrinsic value. I feel like, or no, he mentions book value. I get some of those ratios confused, but um, the way the market is, the market tends to prop stocks up over and above where they maybe should be fairly valued. So I think rule number three is hard, but nonetheless, I do agree with all three.
I'm going to cover these three things in much further detail going forward, but today I'm just going to talk about an overview of what this process looks like. Okay, so rule
So he covers a lot of stuff in this video, and a lot of it, it's like an intro. It should, and all of us on the podcast can definitely expound on these much more significantly. This is more of just an intro. So let's continue.
number one, situational awareness. You have to choose industries that you actually understand. This is one of the core lessons from value investing. Warren Buffett likes to refer to this as his circle of competence. There's an excellent video here. It's very short. I recommend all of you watch it. The core of it is that if you don't understand how the industry works, you should just avoid that company. You should move on to some company that's in an industry that you actually do understand, because part of this is that you have to have a thesis about the industry. And
That is if you're picking good businesses based on the business. Not every investor does that, but I do agree with what he's saying.
if it's an industry you don't understand, your thesis is inherently going to be flawed because you need to have some sort of an idea of its long-term potential. And a big part of that has to do with the business life cycle.
This is a chart I haven't seen since my early econ class. I want to say in high school. We talked about the business life cycle. So good chart.
Every company you would ever want to invest into is in an industry, and you have to understand where that industry is in its maturity stage and also where the business is in its business life cycle. The rules for choosing companies that are fully mature are
So fully mature to that point, a lot of our companies that we're most familiar with, like Tesla, Apple, Google, Microsoft, Amazon, Nvidia, these are fully mature companies. But there's a caveat to that because you'll notice like Nvidia had the biggest market cap gain in history in a single day, even though it would be considered a mature company. So even mature companies still do run up. But this is, again, an intro video. We'll definitely expound on all this further in the future.
different than the rules for choosing companies that are early in their business life cycles. So when I look at high yield dividend payers, I use different criteria than when I'm looking at growth stocks.
Agreed 100% on that. And I like the outline of this video. I like how his 3 points early on are broken down further at this point of the video. It's a very well organized outline.
So if you want to gain additional awareness about an industry, you can look to a variety of places. You can look at news articles, you can go to Wikipedia, you can get on YouTube. But my primary recommendation is to stick to industries that you already know. In addition to understanding the industry, you also have to understand the business model that that company is using within that industry. You can get information on a company's business model by reading their company summary, but the best place that I can send people is to go read their earnings call transcripts.
Agreed on
Those
that.
will usually give you a fairly clear idea of what the company does that generates money. You also have to assess the quality of management. The number one place I go to for that is interviews. Most CEOs will go do live interviews. Just watch a bunch of the interviews. Get a clear picture in your mind of how competent the CEO is. And are they a good decision maker or are they merely a good salesman? This will come into play more when we get to the financial section, but it is easier to identify bad companies than good ones. It is also easier to find a crook than a genius.
Those are interesting points there at the
Okay,
bottom.
so
I
rule
think you have to have some judgment of character for that, but certainly good points there.
number two, you must choose competitive companies with long term compounding potential. The compounding potential part is actually much easier to identify than the competitive part. Competitive companies have what is referred to in the value investing world as moats. They have an unfair competitive advantage over their competition.
It's like how Amazon started, and we see what Amazon became.
Typically, most of the time when you find a duopoly or a monopoly, those businesses have significant moats.
As a refresher, so monopoly is one company controlling the whole industry. A duopoly is two companies. And then to build on that, an oligopoly is a few firms controlling the market share of the whole industry.
When it comes time for me to
And the opposite of monopoly is perfect competition. Game theory, haven't seen this since early econ as well.
evaluate competitiveness, I go to game theory to get those answers. I do basic Nash equilibria
Nash
based off
equilibrium,
of consumer habits,
good stuff.
and then I also do a separate set of Nash equilibria based off of competitor reactions. The goal here is to identify how the rest of the world is going to react to this company's business model over time and how they might react to changes the company makes to their model. When it comes to assessing their long term compounding potential,
Now we're going to get into some ratios here, and I like all of these for sure.
I look at financial statements. And the most important parts of the financial statement are not actually on the statements. You have to do math to get those. They are margins and returns.
But these are easy ratios to do. This is not like calculus or anything. You get the numbers and you're either dividing or subtracting. It's really easy math.
When it comes to margins, I look at gross margin, operating margin, EBITDA margin, net income margin, levered free cash flow margin, and free cash flow margin.
The free cash flow ratios are probably the most important, I would say.
When it comes to returns, I look at return on invested capital, return on capital employed, and return on equity. I will go into further detail on all of these in another video, but there are two important things I need to point out here that come from the financial statements. Only invest into growth companies if their cost of expansion is low, and only invest in dividend companies if they are drowning in cash and buying back shares.
Which is a nice problem to have. And obviously, that doesn't encompass yield max, but I will throw out yield max just for the algorithm, of course.
Rule
Had to do it.
3, only buy things that are trading well below their intrinsic value with a margin of safety. You want to buy
One thing I would add to this, so this is, a basic intro video, and it probably leaves out some of the macro things. Like you have to pay attention to the macro environment, like March of 2020, when COVID first really hit in the US and the markets plummeted. It created a very unique, possibly once in a lifetime buying opportunity, which 6 months from that date, not only did everything recover, but it came back even higher than where it had been. So the macro environment's very important too.
things when they're cheap, when they're on sale. You want to avoid hot companies in hot industries because if it's in the news and everyone is talking about it, it's overvalued.
Not always the case, I would say. I mean, in theory, yes, but we take some of our large companies like Meta. Meta got crushed, then it had a huge run up, of course. But again, this is more of an intro video, and these points are all very valid for the purposes of this video.
So don't buy it. There are many different ways to calculate intrinsic value. The ones that I like the most are the PEGI method, the dividend discount model,
All good ones.
a gram number, and a discounted cash flow. There are also a variety of ways to value pre profit companies. These are companies without positive net income. These valuation methods are typically less reliable, but they're still available to us. Because markets are auction driven,
I really like this chart here. This is a classic economic chart showing the margin of safety. When something's undervalued, it creates a margin of safety because it's trading below its intrinsic value. So I like this type of chart a lot.
the market price is allowed to swing wildly both above and below the intrinsic value of a company. When you buy something that is well under its intrinsic value, you end up buying with a margin of safety. This not only increases your potential returns, this also lowers your risk. So these three simple rules keep me from making bad investments. And I plan on doing a deeper dive on all of the topics that we covered in this video in future installments in this series. So if you want to catch those installments, subscribe.
Consider that New Year's resolution.
Overall, good video, and he's already getting ads, so that's a great sign. YouTube already sees this as monetizable content. If you all haven't subscribed to Blake, this is his channel, Blake Downer EIT. Let's get him to 100 and then eventually 1,000, of course. But yeah, definitely subscribe. And with that, so he hit a lot of the good points, of course. Um, if those don't work for you, sometimes you can come into possession of advanced financial forecasting equipment, such as the 8 ball, like the coach has. And you can ask, is this a good company or not? And immediately it pops up with an answer like, don't count on it. Of course, that's just a joke to be humorous on the video, since this is a bit dry material. Okay, so now that we've covered that, let's do some comments here. We had Varden on waiting for us. Let's go, coach. Doing a twofer. Damon Rydell asked, what's this? It's a reaction video. I promised that I would react to it. Okay, so some of you said you couldn't hear the audio. Some of you said you could. So I will play it back and make sure if there's any issues on my end, I'll just make the video private. But I did it really late at night so that there wasn't too many of you on. So if anything went wrong, we would limit the fallout, so to speak. So Varden can hear it. Travis Moore can hear it. Oh, good. As long as you two can hear it, we're in business for sure. Maybe I'll catch it later when I have my headsets. Yeah, that might have been the issue. He says, Blake, pretty quiet, but you can hear him. Okay, good. Well, thank you all for tuning in. I had promised to do that, and I keep my promises, of course. So hopefully you all enjoyed that. If you haven't subscribed to his channel, definitely do. Like, comment, and subscribe if you haven't already. And we will catch you all tomorrow. Take care. Have a great rest of your evening.